hi everyone. Thank you for joining us today. I'm Jessie Dolmage, an associate planner here at Arnold & Moat Wealth Management. We have just a couple of housekeeping items to cover, and then Matt Hilland, a planner and partner at the firm, will present today's webinar about investing in silver and gold. So today's topic was actually a suggestion from a client. If you happen to have suggestions for future webinar topics, we'd love to hear from you. You can always drop us an email, give us a call, or even put them in the chat box in the bottom part of your screen. During today's presentation, we kindly ask that you remain on mute and type your questions into the chat box, and we'll answer those at the end of the presentation. If you have questions you prefer to discuss with us privately, just let us know and we'll be happy to call you. As a reminder, we do not sell investments, so this is not a sales pitch for commodities. We are sharing the same information that we do with clients as their fee-only fiduciary planners. So with that said, let's turn now to a topic several clients actually have asked us about, and one that's been in the news, investing in gold and silver. So Matt, we're ready and excited to learn more about this. The mic is all yours.
All right. Thank you, Jessie, and thanks for joining us again today. We were really excited to put a webinar together on this topic today. Gold and silver have always been a popular topic for investors. I think the history is really interesting, and I can't think of another investment, that usually has as strong of emotions behind it, as gold does. And especially with headlines recently on rising inflation, gold investing in particular has been on a lot of people's minds. But for those of you where we are managing your investments, you know that gold, silver, or any other commodity really is not part of our normal recommended portfolios. And so we're going to be talking today about how gold and silver have performed historically compared to other investments in a variety of different scenarios, why we don't use gold and silver as default investments for our clients. But we're also going to look at different options you have to buy gold and silver if you want to do it, because, in our opinion, there are certainly good ways to go about buying and investing in gold and silver, and also a couple bad ways. One last thing before we get started. The webinar will focus a lot on investing in gold using the spot price of gold, or in other words, just as gold as a commodity. There's another whole aspect of gold, particularly like historical coins, that gets roped into the topic of gold investing. Since a lot of old coins have gold and silver in them, you might see a lot of historic prices of gold or gold coins, but that can be quite different than the price of just gold as a commodity or just gold bullion without any historic value. And so just for a fun example, I like to put this here on the first slide. This is a picture of the most valuable gold coin ever sold, 1933 double eagle that just sold for about $18 million. And it has just over an ounce of gold in it. So if it had a face value of about $20 when it was minted, and even today, the melt value of this coin is about $2,000. And obviously is worth a lot more than just its value in gold. And so we're not going to be kind of touching the topic of historic coins. If you're depending on Jessie, Quinn, or I to give advice on historic importance or projected value of any coins, you're certainly in the wrong place. But just wanted to say that to get started, because these two topics bleed together quite often, and it can be hard to separate historic value from gold. So from now on, whenever we mention gold, we're talking about simply gold, the commodity. Okay, so to get started, without a doubt, the most common reason for investing in gold and silver is that these commodities supposedly represent a safe store of value. There's no real exact definition for what that means or what relative to what, but you see it repeated over and over again. Gold and silver are always commended for being a store of value. And these are just a few headlines that I pulled up that have been published somewhat recently. And I think this is a pretty common viewpoint. If you asked anyone on the street, they would say that gold and silver is probably considered a safe store of value. And over long periods of time, this has certainly been the case. We know this because gold has been a form of currency for at least a few thousand years. There's a lot of documentation on cost of items or salaries. And just for one really quick kind of fun example, it's pretty well documented that during the reign of Roman Emperor Augustus, this is about 2,000 years ago, Centurion, which is one of the highest ranking members of the Roman army that was on the battlefield, had a salary of about 38.5 ounces of gold, or coins that had that much gold in them. And the value of that is pretty similar to, maybe like a captain in the US Army today. And so, there's a few more examples similar to this one. We know the price of a loaf of bread in 500 BC and what it was in gold. We know how much Roman politicians were given to buy their, dress clothes. Gold has purchased about the same amount of a lot of food and clothing over the last 2,500 years. And it's certainly true that gold has done a good job of maintaining purchasing power over that 2,500-year period. The problem with these examples is that a lot of people think that since gold has maintained purchasing power over this 2,500-year period, that it does over shorter time periods too. And that's the first problem that I see when I hear gold described as a safe store of value, because the last 50 years, the time period since the price of gold was free from its fixed price in dollars, gold has been really pretty volatile and definitely not what you would call a stable asset. This is a chart of the price of gold over the last 50 years that's been adjusted for inflation. And in other words, the price is all in today's dollars. And the first thing to notice is that there's some pretty big swings here. Increases in value are of course good if you own gold, but 60% declines like we saw in the early 80s, 50% declines in the 20-teens is hardly the performance of something that you would consider a safe store of value over any short-term time period. And also worth noting, gold has yet to get back to its inflation-adjusted peak in 1980. Looking at a 41-year history of being underwater on an investment, if you compare that to the stock market, even an investor who bought in September of 1929, right before the Great Depression, did not fare nearly as badly as an investor who bought gold, 50 years later at its peak. And just if you're curious, silver's chart doesn't look a whole lot better or more stable. This is the chart of silver's price per ounce adjusted for inflation as well. And it's a little hard to tell with this chart since the y-axis gets a little bit stretched out because silver's peak in 1980 was really high. But in general, silver has almost been twice as volatile as gold based on standard deviation. And so again, over short periods of time, certainly tough to call it a safe store of value. And my only point with these last couple of charts was just to try to show that if you're making a bet over a short period of time, 5 or 10 years, gold and silver have been really volatile. In fact, they've been much more volatile than just the general stock market. And so if you want an investment to keep your money safe over a short period of time, gold could be a poor choice. And this chart just highlights the drawdowns in the price of gold that we saw in the previous chart. These drawdowns are not adjusted for inflation, but you'll see a few separate decade-long periods where gold was underwater in the last 50 years and some pretty steep declines, as well. 50% drop in the 70s, 60% in the 2000s, 40% around 2015, just to highlight a few of the worst ones that we've seen. And what I think is most interesting about this is not necessarily that gold's been volatile, but when these drawdowns actually have occurred. And this is a table of how gold performed during some notable times of stress in our economy. Most interesting, I think, is the second row here, the recent subprime crisis. And during a time when our country was literally seeing bank runs and the failure of some really large banks and financial institutions like Wachovia or Lehman Brothers, Bear Stearns, just for example, gold fell more than 25% over that time. And maybe it's just me, but I would think gold would be a pretty good investment if you're worried about, the US financial system falling apart. But it turns out, cash or even a few other different investments would have been a much better safe store of value in this time. A few other of these events were periods that saw stress, on other major world economies, not necessarily the US, but the Russia debt crisis saw Russia literally default on its debt, saw triple-digit inflation for the country, and really not a big sign of a demand for gold. Gold went down in value even while, a big economy in the world was struggling. The Asian crisis saw a lot of Southeast Asian countries come close to going bankrupt, and was actually responsible for the US stock market circuit breakers triggering for the first time in history. And so there was actually a lot of panic because of that here too. And you can see from the table, gold was still, hardly a great store of value over these very panicky, uncertain periods. And then the last line in this table I threw in there only because of the recent inflation headlines. And while a 5% drop in gold is not necessarily really significant, the fact that it's coming at a time when inflation is rising a little bit over 5% is interesting, I think. If you had today's headlines, a year ago, you would probably think that gold would have been performing well in this environment. And so far, that certainly has not been the case. And now just to add a little data to that last table, here I added a column to represent the performance of US Treasuries during these times as well. US Treasuries is an asset that we do use in client portfolios for that safe part of their portfolio and to provide a little diversification from stocks. And I won't go through these line by line here, but although treasuries have hardly been entirely immune from any declines, they've certainly been much less volatile than gold. And I think this is pretty significant. Everyone talks about gold or silver as stores of value, certainly in periods of economic uncertainty. And here are, at least the 4 worst economic crises across the globe in the last couple decades. And not only has gold not been that stable during these periods, it's also seen some pretty steep declines. And so if you want an asset that has historically maintained the purchasing power, just the value of your savings over short periods of stress, US Treasuries have done a much better job. And we're going to get into a discussion about long-term returns here in the next couple of slides, but I wanted to put this in here just to show you the long-term impact on your portfolio if you'd use treasuries as that safe investment in your portfolio instead of gold. And while gold has outperformed by about 0.5% a year compared to treasuries, you had to weather some pretty big moves up and down. Specifically, look at the differences in max drawdowns over this period. If gold was going to make up a significant part of your portfolio, and it's not unusual for a retiree to have 30 or 40% in treasuries. So if gold was to make up 30 or 40% of your portfolio and then fell 60%, that's pretty scary. And so when I look at this, if I have to pick one of these assets that I would want to be the safe part of my portfolio and really be dependent on that, maintaining some value, it's a pretty easy choice just looking at the volatility of this. A little less return, but way more protection for the value of your investment. And then this is the last slide before we start looking at some longer term numbers and longer term returns for more growth types of investments. But today, without a doubt, gold is being discussed because of the rise in inflation. And as we already showed, over 2,000-year periods, gold has kept up with inflation, but that hardly means that it does over shorter periods of time. And this table here shows how gold and silver performed during many of the high inflation years of the 70s and early 80s. And don't get me wrong, there were years in the 70s and 80s where gold did very, very well, but it's hardly a given that there's just this blanket rule that if there's inflation, gold and silver will perform well. 1979 in particular, as you can see here, is just about solely responsible for being the reason that I think we think of gold and silver as doing well in inflationary times. These 100% or 400% gains that silver saw really kind of mess with the averages and make the decade look okay. But if you look at any single year in isolation, there's really no correlation between the return of gold and the rate of inflation. And in fact, some pretty big declines in some of the highest years of inflation that we saw in the 70s and 80s. Okay, and so that last slide was a bit of an aside, but one that I thought was important to look at just with the headlines that we're seeing today. We showed that over short periods of time, gold is very volatile. That makes it tough to be considered a safe store of value for any short period of time. But of course, what about the long term? If you're fine with the volatility of gold and you don't need it to protect the value of your investment over a shorter time period, should it still have a place in your portfolio just for those long-term returns that we saw? And so to start thinking about that, I thought about what you could do if you were holding a lot of gold over a long-term period and how that would compare to other potential assets you could buy instead. And so as a fun example, this is Wrigley Field, home of the Chicago Cubs. Even if you haven't been here specifically, most people are pretty familiar with the relative size of a baseball field. And if you bought every ounce of gold in existence today, melted it down, put it in a giant cube, you'd have a cube that measures about 70 feet on each edge. Just to put that in perspective, here's what it would look like, put right on the pitcher's mound at Wrigley Field. And so this gold would be worth about $12.4 trillion. A lot of money, no doubt. It would be great to have that amount of gold. But if your goal was about long-term growth of that investment, think for a second about what this gold would do for you. It's not going to pay you anything. It doesn't produce interest like a bond. It doesn't have earnings or dividends like a stock. It doesn't grow. You're never going to visit one day and find this cube bigger than it was the day before. It's what we call a non-productive asset. And that's the big difference from the types of assets that we use in our client portfolios for long-term savings. If instead you wanted to put that same amount of money as that gold cube to use in other assets, here's what you could buy, instead. You could buy all the farmland in America. This is just under 1 billion acres of land. And even after you bought all that, you could still afford to buy every single share of Apple, every single share of Microsoft, and every single share of Amazon. And I think this is interesting in its own respect, to think about all the gold versus a huge part of the world economy. But what is really interesting, I think, is what these investments and these assets would produce compared to that golden cube. And when you're investing for the long term, you want an asset that can compound your growth to get those really great long-term results like people have seen in the stock market. And these productive assets would give you the opportunity to do just that. Remember, our gold cube would just sit there. It doesn't pay dividends. It doesn't reinvest in itself. It doesn't produce anything. And compare that to those assets we listed on the last slide and shown here. If you instead spent your money on these assets, the farmland would sell about $450 billion in products during the year. Apple would get you another 325 billion, Microsoft 160 billion, Amazon about 419 billion. And so that's $1.35 trillion that would get sent to you just, kind of passively owning that same dollar amount in assets, but owning these productive assets, owning companies and farmland instead. And there's a lot of ways to value these assets. Some people might look at cash that's produced. This would produce about $350 billion in cash in your pocket every year, even after your expenses are paid. Sometimes people like to look at net income. So that's after money that's been reinvested to grow these businesses. Even then you'd have about $250 billion in your pocket just after the first year. You'd still have all these assets, of course, but now you have $250 billion to reinvest into something else, maybe to buy another business or do whatever you want to do. And that's a big difference between that big cube of gold that we looked at a couple of slides ago. And now, of course, no one's deciding between buying all the world's gold or these assets, but the point still stands for smaller investments too. Would you rather have part of that cube, or would you rather have part of these assets and part of the cash flows that are shown here? And this difference doesn't really show up in any single year, but over long periods of time, these productive assets do something that gold and other commodities just really can't do, and that's start to compound your savings. That's reinvesting the cash and the income that we saw on the last slide. And this chart here shows the long-term growth of an equal investment in gold compared to just a diversified basket of large cap growth stocks like the Apple, Amazon, and Microsoft we used on the previous slide. And what you see here is that over time, gold has no way to compete with an asset that gives you this reinvestment potential. It gives you this ability to compound over time. And so this exponential rise at the end of the chart is compounding, beginning to work its magic. And it's why investments like stocks can make such great long-term investments. And so just to summarize, we believe that for most of our client portfolios, or at least for a significant part, gold's too volatile to be really considered that safe store of value that we want for 20 or 40% of your portfolio. Things like cash and US Treasuries and corporate bonds have been much better at protecting the value of your investment over short periods of time, and especially during really high economic stress. And then if you want to invest in something with a multi-decade long time horizon, productive assets like stocks have performed much, much better. And we have a lot of history on this, by the way. That last chart I showed was just over 50 years ago or so, but by now we have close to 200 years of history for the US stock market. And if you look back further, Amsterdam had a formal stock market as early as the 1500s. And the returns that we've experienced in our lives are not way out of the ordinary of the last 500 years in the market. If you really want to put your investments in something for the long term with the potential for long-term growth, it's just really tough to beat the performance of a basket of good companies like are in the stock market. And so lastly, real quick, just on how to invest in gold and silver. Those last few slides tried to show you why we don't believe gold and silver and other commodities deserve a big allocation in your portfolio. But that said, we do completely understand the desire to have some amount of gold. And if it makes you feel better knowing that something is tucked away in gold, then it's good to do. And if you want to, honestly, Quinn and I have both bought a gold coin or two in the past, and that we continue to hold on to. And so, I think it's fun. It's not a significant holding by any means, but it's something that, I do find the appeal to. And I think that's, one of the big benefit in your decision on how to own gold is being able to own it in that physical form. It's, it's nice to have it, to see it, to know it's there. That's something that's pretty different from the stocks and bonds in your portfolio that you're used to, of just kind of being numbers on a screen. But physical ownership can come with some headaches. If you build up a good amount of gold, storage could be a problem. Maybe it's just a safe, maybe you need something better. You might also want to insure it in case it's lost or stolen. And then liquidity can eventually be a problem when you want to sell. And I can tell you personally that I probably would have sold the couple of gold coins that I bought a while ago by now, but it's just hard to get an amount, with a price that's anywhere near the real spot price that you see in the news. And if I were to send these to a big broker, you have to mail it in, they have to examine it, verify that it's real. 2 weeks later, maybe send me a check, and they have pretty high minimums for the amounts that they'll take to sell. And so if you have a smaller amount of gold you want to sell, like to produce kind of a monthly income with your portfolio, like we can do with stocks and bonds very easily, you have to be prepared to kind of handle some liquidity issues, be prepared to take some low offers for that price of gold when you really need to sell it. And so that can be one, big downside for owning physical gold. And then the one warning we have here about investing in physical gold is what's called a self-directed IRA. These are the ads that you see on TV probably about owning gold in your IRA. If you want to own physical gold with money that's in an IRA, you need to open up an IRA at one of these custodians that you've probably seen advertised. You need to send your money there, and then they hold on to the gold. If you want it in your home, you want to touch it, it counts as an IRA distribution, just like taking the money from any of your stocks from your IRA. It becomes taxable. And it also means like rules around IRAs like RMDs or required minimum distributions still apply to gold holdings in this case too. And so every year you're going to have to sell a portion of that physical gold, of course, pay their fees, accept their low asking price for your gold, and do this every time you sell. And so if you can avoid it, I don't think owning physical gold in your IRA is really the best idea. There's lots of fees and just kind of general inconveniences around that. If you want to own gold in your retirement investment accounts and don't mind not being able to physically, see it and touch it, there are options. Listed here are a couple of the most popular gold and silver ETFs that you can buy in any investment account. GLD, for example, is the largest fund here. It's backed by about $60 billion in physical gold that's in a vault. When you buy a share of GLD, what you're actually buying is partial ownership in a trust that owns, $60 billion worth of gold. And so the big pro in doing this is that you have the liquidity of the stock market. You can sell just about any amount of gold or silver in a second at a price that's very close to the actual spot market price of these commodities. The downside with this is there's going to be a bit higher expenses. The fees are going to range, all over the place, but expect to pay a little under 0.5% per year for these fund companies to manage the storage, the security, and the administrative work to kind of run all this. And of course, with this way of buying gold and silver, there's no way of having possession. These funds do actually own gold and silver that's held away, but you can't put your hands on it even if you want to. All you can do is sell the shares and get cash. So although there are still a few cons on this list, if you're talking about a larger investment in gold or silver, or want to use IRA money to make these investments, or are just worried about the liquidity of being able to sell physical gold, to me, this seems like an easy way to get exposure to the price of these commodities and do it pretty easily and without a lot of effort on your part. And so hope we didn't go over time too much. Wanted to cover a lot on that, but I hope you enjoyed. Like I said, we had a lot of fun putting this together. Please let us know if you have any questions either now or next client meeting. We're happy to talk about this again. But if that's all, thanks again and have a great rest of your weekend.